Module 1, Lesson 3. Why understanding bookkeeping mistakes is important. Bookkeeping is the foundation of financial management. However, even small mistakes in bookkeeping can lead to incorrect financial records, tax problems, legal issues, and poor business decisions. By understanding common bookkeeping errors and how to fix them, students can develop good habits that will help ensure accuracy, compliance, and financial stability in any business. Why is it important to understand bookkeeping mistakes? Mistakes happen in every business, but when they are not identified and corrected, they can cause serious financial problems. Learning about bookkeeping mistakes before they happen can help students build strong financial management skills. By studying bookkeeping mistakes, students will see the real impact of bookkeeping errors and how they affect a business's cash flow, profits, and tax obligations. Understand the importance of accuracy in recording financial transactions to ensure a business's success and stability. Learn how to avoid common bookkeeping errors and improve financial management skills. Example: imagine a small bakery that forgets to record some daily sales. Over time, its financial records will show lower income than it actually has. This can lead to underreported profits. Tax authorities may charge penalties for incorrect tax filings. Incorrect financial statements. The owner may think the bakery is struggling when it's actually profitable. Cash flow problems. The bakery may not have enough money for supplies or rent due to inaccurate records. By catching and fixing this mistake early, the bakery can correct its records and avoid tax and financial problems. What can happen if bookkeeping mistakes are not fixed? Bookkeeping mistakes may seem small at first, but over time, they can grow into serious financial and legal issues. Here are the possible consequences of not correcting bookkeeping mistakes. Inaccurate financial reports. If transactions are recorded incorrectly, financial statements, like the income statement or balance sheet, won't reflect the true financial health of the business. Example: if expenses are not recorded properly, a business might think it's making a profit when it's actually losing money. Tax penalties and legal issues. Mistakes in bookkeeping can result in underpayment or overpayment of taxes, leading to government fines, audits, or even legal action. Example: a company forgets to record some of its income. When the tax authorities review the business's records, they find that taxes were underpaid. The company is fined for inaccurate reporting. Cash flow problems. If expenses and income are not recorded accurately, businesses may think they have more money than they actually do, leading to overspending or unpaid bills. Example: a store owner forgets to record a large supplier payment. Thinking they have more cash than they actually do, they spend too much on new inventory. Later, they struggle to pay rent and employee salaries. Poor decision-making. Business owners rely on financial records to make important decisions about spending, investments, and growth. If records are incorrect, they might make bad financial choices that hurt the business. Example: a company records a large business loan as revenue, instead a liability. This mistake makes the company look more profitable than it actually is, causing the owner to overspend. When loan payments are due, the company doesn't have enough cash to cover them.